Good morning. I have a distinguished panel with me. Most of them you already know, or there's a chance that you would have already spoken to them. This panel is and this conversation is very appropriate because of the theme that the whole conference has and the beautiful tone which Dev has set with the facts just before the conference. So I think the question really, when we talk about scaling of private credit, I think the question not really is that whether private credit is going to grow or how much it will grow, because all those facts are there with the bullhorn. I think the question and the theme that we will try to capture today is that how it's going to grow, where the capital is going to come from, where the capital is going to be largely deployed in our view, and questions on underwriting and portfolio build-up. So I think without further ado, we had a brief introductions of each of the panelists, but I would let them just talk about their platform as well when I come to them with the first question. So, and this is for all the panelists, maybe starting with Vineet. So when we talk about private credit growth, how do you think, from your vantage point, has private credit really grown in India? And how do you think it is evolving? In which direction is it going?
Thank you. I think from one perspective to look at when we look at private credit is the role that it plays in the larger economy of mid-market SMEs that seek to raise capital that is different from what banks can give them. Let's put some numbers. Between 2015 and 2025, roughly a 10-year period, bond issuances have grown from roughly 5 lakh crores to 23 lakh crores. Okay, that's a 4x growth. But if you take only BBB, BB unrated, which is a segment where I think all of us play to the maximum extent, that's grown from 0.3 lakh crores to 4.5 lakh crores, right? So you have, while the market has grown 4x, the relevant segment which was earlier termed as the so-called junk bond market, or where capital was barely flowing, has actually grown 15x, right? So that gives you a very real sense of where this market is taking us, what is the role that private credit plays, and why it is so exciting that in a market which is where you do not have public data, you do not have you don't have research tracking these companies, but it has become a very large and robust place where there is price discovery and hundreds of more issuers being discovered every day, right? India has roughly around 18 to 20,000 odd mid-corporates today, depending on what definitions you use. And even today, after the growth that we have seen, I think less than a tenth of them have actually ever issued a bond, right? So we have a very long way to go from here.
So yeah, good morning everyone. So I think just to add to what Vineet is saying. So I think multi-strategy, multifold stuff is what I think all of us do. Like for example, we do mid-market performing companies, and absolutely like what Vineet said is that the whole sort of the whole sort of attitude is around say 18 to 20,000. We feel there are 4,000 active bankable companies, which actually, out of which hardly maybe 25 or 30 odd % would be listed. And so there is so many of those mid-market companies pan-India which are really looking at growth capital. So we've really spent a lot of time doing a lot of market research and sort of spending a lot of time pan-India. So we add, for example, almost like 5 cities every year, tier 2, tier 3 cities, where we actually go and look at sort of, meeting up with various chart accountants and various corporates and working with them. And absolutely right, as you rightly said on the size, like we've been there for a decade now in the fundraise. From a first fund of 50 million to $1 billion is what we are now currently raising. So that's the size we are looking at the whole private credit growing at.
Hi, morning. So look, I guess we at Evolutionix bring a different perspective to this. So while we are a growth stage credit fund, we focus significantly on tech-enabled and new age businesses. And I think if you look at historically, I mean, there are a number of private credit funds, including my co-panelists, we've kind of built this asset class. We started relatively young, just 4 years back, and we've created this kind of segment where we are looking at, asset-light businesses, loss-making, cash-burning businesses, and which need a slightly differentiated kind of underwriting. And that's what we have kind of focused on and built this platform. and invested close to $500 million across India, Southeast Asia, and the Middle East. And I guess this capital, as we see the trends in the US, there is a need for this capital as an alternate to equity capital. I mean, a lot of growing unicorns and tech businesses were historically funded only by equity. And that's where we saw this white space and saying, look, this is where the gap in the market is. And that's where our LPs, Temasek and DBS set this platform, which is an Asia-wide platform, to focus on this segment. So that's essentially a bit of a niche segment that we play in as part of a larger private credit framework.
So private credit has, I think, clearly come a long way in last particularly 5 years. I think it has gained significant scale, depth, breadth in these years. We have beat on any metric: fundraise, deployment, deal flow, number of new managers, etc., or the large value deal that the market can absorb now. Also, I think the kind of strategies, the range of strategies we see today, I think again, going back even 5 years until 2020, we had a handful of funds focusing mainly on special fits, a little bit of distressed type of strategies, and today we have funds across the yield curve, right from direct lending style, performing credit, to various variants of special fits and opportunistic capital, hybrid capital, specialist strategies like venture debt, RE credit, etc. And I think private credit has truly arrived in its own right as a distinct asset class rather than sitting on the fringes when it comes to investors' allocation decisions. So I think overall we are at a definitely have come a long way in the last 5 years. But I would just add here that we are still in early age of evolution, and we'll talk about as we go in terms of what more can happen from here.
Hi everyone. So today here I represent 360 ONE. We are an integrated wealth and asset management platform. On the asset management side, we manage AUM close to about $11 billion, and out of which private credit is roughly about $2 billion, largely focusing on the performing credit space. From our vantage point, being an integrated wealth and asset management player, I would say from an evolution of private credit, yes, definitely I would agree with the rest of the panelists that we have come a long way. A couple of points there, when we speak to borrowers, promoters and CFOs, I think increasingly they do understand the value of private credit, and agree with Piyush earlier, it was largely focused on distressed, but there are a lot more flexible end users that this private credit can actually solve for. Second, I would say, is with respect to domestic capital. I think if I were to quote some statistics, I think last year itself close to about 60 or 65% of private credit was largely catered to by domestic managers, which are fueled by domestic capital. So a lot more of domestic capital is actually growing private credit, and family offices are also becoming savvier and asking the right questions with regard to credit. And we are seeing increasingly, I would say, large ticket sizes deals. Just if I were to quote with respect to 360 ONE, last 12 months, we would have done close to about 7 to 8 odd deals which were $100 million plus. So I think, yes, the depth of the market is increasing. But yes, we are still in nascent stages and there's a lot more to do in this space.
Sundaram Alternates is about 8 years old. I think we were there relatively, I would say, from the beginning of when private credit became a thing. We currently run 12,000 crores of AUM, of which 8,000 crores is credit. We are present in real estate credit. We are also there in credit special opportunities and performing credit. So actually my colleagues covered pretty much all the points that I wanted to make. So bottom line, I took some inspiration from Dev's analogy, where he went through IBC. So just 2 minutes, on my evolution, which I think is the question Rajiv posed. So I think private credit has always been there in some form or fashion in India. Rewind 30 years ago, there were banks, and for things that banks couldn't finance, which was a lot, there were money lenders. right? And so I would call that, probably like a pre-private credit stage. And then when the AIF regulations were introduced, by then already, I think some of the momentum for alternate credit started moving slowly. I remember prompted by one of the ex-chairman of SBI, who said that SBI is now looking to move from a relationship bank to a transaction bank, I think culturally, I think in 2010. And from then on, I think a lot of the spawning of the NBFC movement came, where NBFCs took front and center stage in terms of alternate credit, whether it's all the asset classes we're talking about. So there was a period of initially banks and money lenders, and then from 2012 onwards to 2022, it was banks and NBFCs, okay? And then the AIF regulations gained momentum with the NBFC collapse and so on and so forth, and then funds came into its own. And so today, I think we're in a phase where it's still early stages, but I think it's a period of cohabitation where increasingly alternate capital is being recognized as synonymous with private credit funds, but we still have to coexist along with banks and NBFCs in terms of deals and so on and so forth. So I see that in this period, private credit is sort of coming into its own, is being recognized as part of mainstream. So it's a little bit like a Darwin's theory of evolution. I call it the replacement capital evolution, where slowly I think alternate capital is starting to get replaced over time periods of 10 years or a decade each. So I think we're in that period of cohabitation, and I think the next 5 to 7 years, once the cohabitation sort of plays out, I think the pyramid will start getting inverted, starting from banks, NBFCs, credit funds to NBFCs, credit funds to credit funds. So I think that is sort of the evolution of the Venn diagram, I would think. So I'm going to stop there, otherwise I keep going.
Thank you, everyone. I think that was very helpful. And the theme, what Karthik really said, that private credit has always been there. And the way it has evolved now is it has gone to markets beyond the tier 1 cities. It has gone to the sectors which are underpenetrated. And in terms of deal size, which Kavita mentioned, that now, just one platform talking about deals which are 100 million plus, 8 deals in a year. And the involvement of domestic pools of capital in the growth of private credit. I think these are the common themes for its evolution. Now, talking about the last point in terms of domestic pools of capital, I think Piyush, Sandeep, and Kavita, this question is for you. So, when we talk about the domestic pool of capital, what is really attracting domestic pool of capital, which is in the form of family offices and HNIs, ultra HNIs, and even the global capital? What is attracting it to the Indian private credit industry? And what are the factors which are giving confidence in this asset class? Or if there is something which is also holding the investors back. So maybe Kavita, we can start with you.
Sure, thanks. So I would say, across, of course, domestic capital as well as global institutions, couple of factors which are attracting to an asset class. Specifically, I would say private credit definitely is a consistently compounding asset class, right? If you compare that with, let's say, an equity or a listed equity across cycles. So that is something which is attracting investors. And of course, there is a lot more to do with downside protection, which the asset class offers. Lastly, from a relative value perspective, with the way that regulations have also opened up and a lot of arbitrage has gone away today, mostly looking at family offices, this is an alpha and also a much better position that some of the family offices look at it if you compare with some of the fixed income opportunities. And some of the foreign investors also, when we were on a couple of road shows, let's say across Singapore and Japan, and with everything which is happening today from a geopolitical perspective as well, and the news articles that we are reading with respect to US private credit, I think a few key themes which are emerging is de-dollarization, diversification away from the Western economies, and of course when you look at APAC, India is one of the largest private credit markets, so it's a market which one cannot ignore. So I think, yes, and IBC has also played a significant role in that. So all of these factors do sort of instill that confidence for both domestic as well as global capital to come to India. And with respect to what can be done and much more, instill much more confidence for these investors, I would say is yes, with respect to IBC, we have done significant improvements there, but yes, in terms of recovery times and in terms of recovery values, there is still a long way to go with respect to that. Yeah.
Thank Kavita. Piyush, maybe you can give your perspective.
Sure. So let me first talk about the domestic capital, and then I'll come to foreign. So I think on the domestic capital, especially wealth, well, we are starting from, or rather we started from a zero base, let's say 5-6 years back. As I said earlier, the asset class didn't really exist in terms of investor allocations as an LP until say 2020 on the domestic side. So I mean, compared to where global family offices are, who typically have at least 4 to 5%, depending on what data point you look at in terms of their asset allocation to private credit. Indian family offices were at zero a few years back and obviously are now catching up. And for all the reasons mentioned earlier, I think low correlation to public markets and hence lower volatility, periodic cash flow, lower holding periods compared to say private equity and infrastructure funds. So for all those reasons, you know, private credit obviously has attracted a fair bit of domestic wealth capital over the last few years. Coming to foreign capital, while Sandeep can add later, I would say there is some bit of strategic rebalancing that is happening and should gain pace further. I think given all the issues that have happened in US and some of the unhealthy or not so healthy practices, you know, that have kind of come up there. So there is some reallocation that is happening and is going to expected to happen more away from US private credit, where historically there has been you know, a lot of allocation. I think Europe is already seeing some benefit of that earlier this year, and one would expect that Asia and India should also, going forward, you know, see some reallocation benefit. Overall, I think compared to, let's say, US, which is obviously the largest private credit market, I think India does offer, I think for a minute, just setting aside the fact that US rates are where they are, so there's some relative value disadvantage, and obviously in US you get leverage returns as well, which in India, at least in Cat 2, we can't offer. But that apart, overall in terms of the you know, the robustness of underwriting, I think on an apple-to-apple comparison, I think there's a growing realization that in India the leverage levels are a lot less, a lot more moderate. LTVs are you know, better, covenant structures are more robust compared to US, where BSL is 90% covenant light, or even private credit market is like almost 50% covenant light. So I think for all those reasons, one would expect that you know, we should see increasing allocation by global capital to India. And I would add that, you know, all the IBC reforms that are happening give further confidence. Plus on the regulatory side, all the increase in the levels of transparency, reporting, conflict management, etc., all that gives further confidence to investors.
Yeah. So I think, you know, last sort of 6-7 years post-COVID, we've done a substantial amount of capital raise, both domestic as well as offshore. So I think if you break this into the ultra HNI family offices, I think both, even domestic now, the institution capital is increasing. So the banks have again been allowed by RBI. So I think the sort of guidelines have again been changed for the banks to, you know, to allow them to sort of start investing into independent credit funds, as well as on the insurance company. So I think couple of points which have led to both, you know, HNI as well as the, you know, as well as institution capital. I think one is, for example, last, you know, since the time we've started, the last 12 years, we've never done a single deal at zero coupon. So I think somewhere credit is basically, people are looking at sort of some amount of sort of cash flow which is sort of coming to them on a sort of regular basis, on a illiquid sort of premium, which is, this is sort of a illiquid premium that you're paying for a hold to maturity paper, which is, I think all of us run close-ended funds. So in that sense, that is what you're paying. Second is, I think clearly is that we, we actually, most of the global as well as institutional investors clearly see the kind of deals that you look in manufacturing, service. Some of these, and I think Vineet made this point earlier, is that some of these industries or some of these companies, you perhaps will have practically impossible way to reach out to them and sort of invest in those companies. So the private market or the private credit market in that sense gets those kind of deals on the platform. And also we clearly feel that every fund of ours, for example, throws at least 4 or 5 great equity stories out of it. So I think also all those points put together, I clearly feel that private credit clearly gets that edge of ultra HNI, as well as I think both family offices, ultra HNI institutions, as well as offshore institutions. For example, the increase in domestic capital is to this extent where we have actually crossed the domestic. We have half the fund raise, and we have crossed what we did the previous fund. We sort of almost double that amount on domestic fundraise alone. So in that sense, that's the allocation which is starting to increase. I think one key factor that we feel is, is that your team, in that sense, is that has the fund manager, not just at the founder level, but even at maybe 1 or 2 levels below, how stable has the team been and how consistent is your performance, how regular have your cash payouts been. All those things are sort of adding to more and more capital coming into the space.
Thank you. I think all the factors that you have stated sort of aligns with the facts which we read in the reports which are coming out, both in terms of capital raise and deployment. I think let's switch gears from the and maybe zoom into the motivation of the LPs. Now as they become, that the market matures and the LPs are becoming more appreciative of the risk reward. The question I had is that, and maybe Karthik, we can start with you. Are the LPs simply looking for the fund exposure, or they're asking for more in terms of co-investment, more or broader access? And in your view, how does that change the dynamics in terms of portfolio creation? And maybe after Karthik, we can come to Vineet.
Yeah, so definitely investors are asking for co-investments, MFN rights, multi-fund rights, and so on and so forth. That's a fact. But I think just to put that in context and in perspective to the points that Sandeep was making a few minutes ago, I think it's important to understand the segmentation of domestic LPs. I think this is more a domestic LP question, I would think, because offshore LPs are very standard. They read off the template. So I think the sort of HNIs between 1 and 10 crores, and then you have the ultra HNIs in the family offices who are much higher. And then you have institutions, who comprise insurance companies, pensions, and so on. And then, of course, offshore. So amongst I would think that the largest proportion of LPs or in Indian funds are really the HNIs. I think they roughly comprise between 30 and maybe pushing 40%, maybe higher. Most of us don't have the good problems that Sandeep has in terms of scale of capital. So, in the domestic LP market, I would say a substantial portion comes from domestic HNIs on the 1 to 10 crore sort of ticket, and they are not really asking for all this, largely from our experience. So I think what they look for is a search for yield, a rebalancing of their own asset portfolios in terms of shifting from debt mutual funds and FDs into yield origination vehicles. They're looking to try and do strategic shifts from, let's say, a private equity asset class to private credit because of the points made earlier in terms of visibility, consistency of cash, upfronting of returns, to the point of not, doing redemption and, pay-enabled structures. So I think that is a lot of the driver for them. But for the rest, absolutely, they are seeking, a larger, innovative, I would say, vehicles that help them manage bespoke vehicles, create custom portfolios, have options to do credit and equity, listed and unlisted. And I think SEBI, in its wisdom, has introduced, various vehicles, like, for example, the large value fund, which we discussed in the last IBCA credit panel, where we had, the SEBI executive director on the panel as well. It's a very interesting vehicle where you can create a bespoke portfolio for an investor who can commit for an accredited investor more than 10 crores. It's, we are sort of starting to do that. But at the same time, I think there probably needs a little more recognition of the fact that this is a real ask. And consequently, some of these regulations, particularly around co-investments, can be made easier for managers to offer, and probably more friendly, less rigid structures might be the thing that the doctor ordered today.
So co-investment, I think, is here to stay for quite some time. What began as a cost management strategy by family offices to say that what I put in your vehicle might meet what your PPM needs, but I'll average my cost out by taking direct shares of specific transactions. This as a cost management strategy is here to stay, and I think everyone has to figure out ways to manage this. We're actually seeing a very similar trend internationally as well. I think we are seeing global pensions, we are seeing semi-sovereigns also speaking the same language. Over the last 10 years, what began as an allocation strategy with asset managers has now evolved into teams that are actually evaluating single transactions and saying that, can I invest in X trade, Y trade, Z trade alongside you? Or even better, that I will first invest alongside you, evaluate the decisions you make, and then come into your fund. Right? So it's getting into that kind of a conversation today. Now, what does this mean for someone like us? There are two implications. One implication is that the complexity goes up. So rather than managing one pool of capital and take one kind of decision, now we have to kind of figure out how to allocate across multiple pools of capital. So complexity, contracting, technology, all that good stuff starts expanding. I would say partly unnecessarily. Secondly, you're seeing LPs creating what I think are more concentrated portfolios. That has an implication. If they pick up 2 transactions rather than the 20 that are in the portfolio, the chances of their losing money is higher, a bad experience is higher, that can have reputational impact on the asset manager. All these are becoming almost more and more certain with time. And the third, I think, is that it is driving many of us deeply into the HNI market. Because, as he said, the HNIs do not seek this at 1 crore, what will you co-invest? And that is a very granular base which, might have asks in terms of, pricing and so on and so forth, but from a decisioning and portfolio perspective, are not asking these kind of questions and making these demands, right? So 3 implications. All of this are, I would say, necessary evils in a sense, as the market matures more, but becoming more and more necessary.
Sorry, if I may just
add.
Yeah,
please.
I think co-investment is definitely a powerful tool, and I'm speaking on behalf of 361, where we have seen this as a huge value add. I was earlier mentioning that we have done trades of $100 million plus, and a lot of that has actually been contributed through our co-investment pools. So when we have, and even recently when we did almost a $250 million trade, almost 40-50% of the allocation went through co-investment. So it's a significant driver, I think. And apart from getting that access to individual credit, I think it also fuels capital into the blind pool, and it's an attraction, especially for UHNIs and family offices, to get convinced on some of those co-investment opportunities to then drive that capital also into the blind pool. But yes, 100% agree with Vineet that you need to be, as an asset management fund house, you need to be, you need to have high conviction on those particular trades for you to then go and offer that as a co-investment to your LP base.
Thank you. So I think one thing it reestablishes is that the capital is there and the motivation is also changing. Now let's talk about deployment. Maybe I wanted to start with you, Sandeep. While the market scales in terms of the capital that we are raising, in terms of use cases, in terms of strategies, in terms of more structures, where do you think we are heading in terms of deployment? What is going to, to your mind, going to occupy, the deployment more predominantly in the next 5 to 10 years?
So I think one of the major things I think is good underwriting. So I think good underwriting and not enforcement. So I think that's the key. So the idea is that for deployment to happen, you have to have extremely disciplined way of managing your asset, which includes the whole underwriting process, the whole asset management process. We work with a team of a single strategy in that sense, except the duration fund that we have. We work on single strategy, which is performing companies, and it's a 21-member team, which is just the investment team, and an overall a 40-member team that we work with. So in that sense, it just needs that kind of people across, to do the entire financial management, to do the entire due diligence, which is right from financial diligence to do a sort of legal due diligence, and then sort of do the whole underwriting concept. So I think that's the key of the entire strategy, that you would sort of look at the whole underwriting process, which is, I feel, is one of the most important parts of. So I think the allocation, I think one big thing which I feel has happened in the Indian markets is that the mid-market, promoters have, the whole mindset has really, in that sense changed. So I think clearly non-dilutable equity in that sense, which is what private credit provides them, has started making a lot of sense to them. So in that sense, there's also now more proactive in coming to you and saying that, okay, fine, this solution actually makes sense. I don't need to. Not everybody wants to do a PE, or not everybody wants to do an IPO, but everybody needs growth capital. So and what Karthik had earlier said is that the whole private financing market is sort of getting replaced by more organized capital. I think the second big change which has happened at the promoter levels, we feel, is that at 20-25% income tax rates, I think a lot of Indian promoters have really cleaned up balance sheets. So you really have some real good numbers now actually which get reflected. You have professional teams. So you really have good asset that you can today go and back and sort of start investing in.
Thanks, Sandeep. I think, Rahul, from your lens, what you're focusing on, where do you see the opportunities?
Yeah, look, I guess if you take a step back, historically, if you look at last decade or so, the two key asset classes which did very well. Venture debt as a asset class did very well. There are a lot of funds after which was set up first, and foreign that's done very well. And there are a number of performing credit and special sits fund as well which were established. I think if you look at next 5 to 10 years and where we focus on more, I would say, new age businesses, asset-light businesses, we've seen in last 4 years of our journey that there is a need for this capital. We see a lot of demand for this alternate capital to this asset-light businesses across tech and EVs, data centers, AI-related businesses, etc., which needs a slightly differentiated credit. The underwriting is not based on collaterals; it's more based on business models, and how the company will continue to be a leader and will continue to raise equity. So we take a slightly different lens. We form an equity view on the business and then try to put a debt structure around it with the right covenants and triggers. And that's where we see that increasingly, if you see the market in the US, there's significant growth in this kind of financing. I don't think India will take a number of years to get there, but I think from an incremental growth perspective, we see a lot of demand for this capital. But having said that, you see Dev's opening discussion, I think we don't feature, it's a very niche segment. So a significant part of private credit is to real estate, infrastructure, industrials. And this is still a very small segment, but I would say a very high growing segment over the next 5 to 10 years.
Thanks, Rahul. Kavita, maybe you can give a broader.
Yeah, I think in terms of opportunity, I think private credit will definitely be useful as a form of growth capital. And if you're looking at India and it's estimated to become a $7 trillion or a $10 trillion economy over the next, let's say, 5 to 7 years, then I think all pools of capital need to come together for that number to be envisioned, right? And private credit will fuel a lot more of growth capital. I think specific sectors where we are particularly bullish upon, I would say, is infrastructure and healthcare, where even today we are seeing significant amount of opportunities.
While it is scaling, the contribution of private credit to industry credit is still low. So I think there is a lot of headroom for everyone to sort of increase the allocation here. Now let's talk. Now we've been speaking about the private credit growth. and private credit has enjoyed a lot of white space for a long time. But now the regulatory shifts are happening in the sense that the Reserve Bank of India has now relaxed the acquisition financing norms in two ways. One, it has allowed the domestic banks to sort of fund it, of course, with the limitations which are, or the conditionalities which are attached, and the gating conditions. On the other hand, the external commercial borrowings norms have been relaxed like never before in terms of end use have been widened. The all-in cost has completely gone, and the investor and the borrower base has been fully expanded. So the question really is that what does it do from a private credit standpoint? Is it merely a competition, or do you see it as widening the financial architecture? I think maybe I'll ask Karthik to.
Hello. Yeah. So far, we haven't seen the two specific things you said, ECBs and acquisition financing by banks to be competitive, because I think opportunities that we encounter are largely in mid and smaller sized companies, which continue with the fundamental thesis of private credit to have difficulty in accessing banks, or it takes time. And they're probably a little too early to access public markets, or there is some sort of a special situation that actually warrants fairly nimble and flexible capital, which I don't think culturally yet banks are in a position to provide. The rupee depreciation, I think they've pointed out, continues to be a stumbling block regardless of all-in and so on and so forth. So you really don't know what your borrowing costs are when you go in for ECBs, but we'll see how that plays out. It's still early days. So while there is a bunch of, or rather a few of these small sort of regulatory shifts, I think the large disruptors can potentially, from a regulatory standpoint, be for the positive. And this again goes back to the conversations that we've had so far in terms of why has private credit grown, what has been the drivers that have pushed flows and volume. So I think, for example, the hawkishness of RBI, and in just for a second on the real estate context, NBFCs, I think a year and a half ago, couldn't finance land anymore. So that firmly put land financing in private credit, bucket. And then, you have, several other sort of potential hawkish measures, to do with provisioning, and so on and so forth, to the point where RBI has introduced a guideline for regulatory entities, which our sponsor falls under, regulated entities, where they limited the amount of exposure to AIFs and so on. So I think there is a clear view to distinguish the cheapest and the largest pocket of financing, which is the banks, away from the space, and get them to focus on different kinds of risk that are more controllable and less subprime, and have the rest of the risks, wholesale company corporate risks, flow to the private credit, right? I think there is a series of underlying positive drivers from a regulatory standpoint towards private credit as a growth. A lot more, can clearly be done. As we talked about, easing co-investment, regulations, allowing LBOs, to happen, which I think is an effort that the IVCA is also sort of taking up. So there's significant amount of positive drivers versus negative regulatory shifts, in my opinion.
Just to add to this, I think what Karthik was saying, I think we clearly feel, I agree with Karthik, is that the positives are very clearly that we actually feel that banks at times have started treating private credit, people like us, like the alternative investment funds like us, as more complementary to their sort of lending and not as competition. So they actually feel that a mid-sized company would need all forms of capital, besides the equity which is coming in, and besides that equity and the bank debt, he needs that alternate form of capital, and it's not necessarily that it comes in the form of equity. It can come in the form of sort of quasi equity, which is a debt format. So I think that now that we clearly feel that visible, and that of course depends on bank to bank, and depends not across all banks, but lots of banks, a lot of private sector banks especially, have started treating this as more complement to their sort of lending.
Sorry to just one more point I wanted to make is, but SEBI on the other hand can do a lot more. For example, Surfacey is something that is, I think, today available only on listed NCDs. So why not unlisted NCDs, right? I mean, it's a question that everybody is asking in the industry, right? And also the introduction of the SIF in the mutual fund framework, right? So it comes months after raising PMS minimum limits from 25 to 50 lakhs, and then you go and allow a SIF, which is accessible to alternate markets with 10 lakhs, right? So I think these are sort of disruptive things more, I would say, to the industry versus perhaps some of these RBI measures. But I think if these somehow can find some logic and a level playing field can be created, nothing to stop flows into the space and inverting that pyramid.
And just to supplement to that, when these relaxations happen, they sort of, also speak about the market maturity, right? Because the RBI is saying that now you could do this is because it's an assessment that now the market is ready for it. So, and in terms of your points on Surfacey, I think maturity is what is needed for, when the access was extended from banks and NBFCs to listed debt. It came from a maturity standpoint. So I think as the market matures further, I think that is the next thing which will probably be relaxed by the government. So Piyush, I'll come.
Yeah, I'll just add a couple of points to that. So specifically coming to your question on the impact of acquisition financing for banks being relaxed and ECB being relaxed now. So I think the whole debate about how much it will impact private credit, I think is a little overstated. To my mind, private credit can certainly coexist and will coexist with banks and other debt capital markets. First of all, talking about bank financing, regulator has put guardrails. So you still can't do non-control acquisition financing. You still can't do true LBO style acquisition financing where you don't have a corporate guarantee from the parent, or you can take more than a certain percentage of shares of the target as pledged given the Banking Regulation Act provisions. You have minimum net worth, maximum leverage. You still, FOCC debt is still outside the purview. And in any case, banks, as we know, don't have as much appetite for proper core mid-market term risk or asset-light services business. So I think there's ample white space still available for private credit, besides the fact that the use case for private credit is anyway quite different. So that's point number one. On ECBs, I really can't see how, while it's certainly transformational for corporate lending, for project financing, debt capital market issuers, but for private credit, I don't really see it, moving the needle that much, because I think for pools of private credit capital like the global funds, Asian funds, they always had access to deal flow in India through FPI route. And if we include the listed FPI NCDs, then incrementally ECB is not really going to attract any or going to offer any comprehensive relaxations over and above. There's still 3-year MAMP, except in certain cases for the manufacturing companies. Withholding tax is still applicable, and so on and so forth. So I think if we look at the global context, there have been no such restrictions for banks globally, and the corporate bond market has been far more evolved in, say, US. But we have still seen private credit growing and flourishing, and banks, in fact, getting into partnership with private credit. So I think that's what we probably see in India.
Thanks, Piyush. Maybe Vineet, if you could just.
Have we seen an impact on transactions, let us say, in the recent past? Answer is no. Perhaps it is because our house focuses more on the 15 to 50 million category, where potentially it is still expensive for a bank or a large international bank to evaluate and execute a trade for an Indian entity. There are many fundamental barriers, I think my colleagues have well articulated. Currency is a significant one amongst them. The availability of hedging lines is a significant problem even now, extending up to 3 years, 5 years, etc., etc. So a useful point to note is that at a very generic, in a very generic way, if these two changes in regulations help in building risk appetite for, let us say, large M&A transactions, large corporates, large listed companies. It's a good thing because it means that some of us will actually have the comfort of knowing that the refinancing opportunities are larger 3 years from now than what they are today, right? So I think this is a net positive. It's always good for the market to have more options. It's always good in a growing market for the pie to be split in more ways, because at the end of the day, we will grow at a certain pace, the market can grow faster as well. And it's good that there is risk appetite available when companies become larger, because that can be a very useful takeout for many of us.
Thanks, Vineet. I think I can hear the unison and the common voice that it's more complementary rather than competitive. Now let's maybe talk about underwriting. So Kavita and Sandeep, I just wanted your your perspective. Maybe we can start with Kavita. That now that with the market, the way the market is scaling now, how are managers thinking about the underwriting, the asset quality, the investing discipline? If you could talk about that.
Sure. Slightly go a little technical here, coming from a banking background. I think it fundamentally for us boils down to PD and LGD. I think yes, a lot of us place importance to PD, which is essentially ring fencing, cash flows, etc. But I think it's equally or probably more important to focus on LGD, which is lowering your loss given default. And I think two tenets for us in order to lower this would be one, to essentially negotiate at the time of structuring itself diverse non-correlated pools of collateral, so that you are not reliant on just one particular pool of collateral, and if there is certain volatility which does happen in the market, you have other potential uncorrelated pieces of collateral like financial assets of the promoter or other businesses to actually rely upon. And second, I would say, is essentially control of the debt stack, largely in line with how even IBC today views the enforcement situation as well. I would say in all our transactions, we ensure that we are at least, if not the sole lender, then at least more than 2/3 majority on the overall debt stack, so that we can single-handedly, if a situation does turn volatile, enforce and not really rely on any other lender. So I would say these two things are of utmost importance for us, and scale and the way that we have grown today and our ability to do large-scale transactions has been a massive driver for us in order to be able to achieve both of this.
So I think just to add to what I think Kavita was saying, I think that's true. So I think for us, it's always been cash is king. So in that sense that if you are operating level company sort of lenders, and we always believe that return of capital is more important than return on capital. So that's very, very clear funda that we worked with, and for us our clients are our LPs and not the borrowing entity. So from that perspective, when you start thinking and doing underwriting, is when you actually start saying that how much of cash flow. We love the moderately leverage companies, which is more debt EBITDA is a key ratio that we would work is what's the kind of cash, actual cash that they are generating and not accounting cash that they are generating, what's the kind of past performance they have been. So when you do sort of vintage companies which have been in the market for say 15, 20, 25 years, and these are all bankable companies. So they all have existing bank lines which they are actually sort of still running with. We actually don't normally lend to more like first time borrowers. So in that sense, these are all vintage companies which is there. So I think these are some of those underwriting principles which is very clear. And as I said earlier, that for us, our quarter servicing is like a given, in the sense that I think in Indian context, in Indian sort of, we still have most of the corporates in India are promoter driven and not sponsor driven, which actually come and take private credit. And we clearly feel that a no better due diligence is than to really make him. I always tell that till the time your account is not debited every quarter and our account credited, that due diligence is not really complete to that extent. So I think cash is the key. I think of course collateral, we all do senior secured lending. Collateral is of course there, but our key focus has always been on how much of cash is the company generating and what's the overall leverage, and then sort of run that entire 5-year, 6-year on a continuous sort of monitoring. And that monitoring is at different levels, which is right from the accountant to the to the production guy and going up to the promoter level. So I think that's the kind of vintage that we have built up across various sort of investee companies that we've put money in.
Thanks, Sandeep. I think we are speaking of downside protection. So, Rahul, I have a question for you that you have also seen, or at least have had conversations internally with the stakeholders about other markets, and considering who the stakeholders are. How do you see that the Indian market fares in terms of creditor rights, and or if there is anything which you feel should improve?
Yeah, sure. So look, two parts to it. I mean, firstly, just to add a bit of nuance to what Sandeep said on the underwriting. I mean, the way we look at this business is we in most of the business that we've invested, there's hardly any collateral, there's hardly any EBITDA. They're all cash burning businesses. They don't have real estate, they don't have fixed assets, plant and machinery. Promoters, the founders hardly own single digit stakes, so there's no share pledge. So it's a very differential underwriting. And there are two things that we look for. One is that we take an equity view on the business, and we see that, look, will this business survive at every point of the cycle, and will it be able to raise equity? And that's a key metrics that we look at when we underwrite businesses. And we have seen across last 4 years of our track record that, look, 80% of our portfolio companies have raised equity at different valuations, but even through a downturn. So that justified that kind of underwriting model. I think to your question on the creditor rights, so look, I think when we look at, across Asia, so when we invest across India, the Middle East, UAE and Saudi mainly, to Southeast Asia like, Indonesia, Vietnam, Singapore, the difference is, I mean, UAE has done a fantastic job, when they set up the English law jurisdiction in DIFs and EDGM. And that's given a lot of comfort to, foreign investors, because they are very much similar to English law jurisdictions. On the other side, we see, emerging markets like Indonesia or Vietnam, where, the regulations are far behind, or the creditor rights are, I would say, quite weak comparatively. And the differentiation is far higher when you look at onshore collateral. So when you're doing lending on real estate collaterals or, fixed asset, that's far more difficult than do lending on, say, movable security like shares or, bank accounts or current accounts or inventories. So that's where we've seen. And I think a lot of these emerging market economies are kind of learning from India. So the way IBC and NCLD frameworks are developed in India, a lot of them are taking inspiration, also copying a lot of those stuff. But still a journey, I guess, for a few years for them to catch up compared to where they are.
Thanks, Rahul. I think that was an interesting perspective. I think that was our time, I think. And I'm not sure if we have time for questions. We can take one? Yeah, okay.
Hi, my question is to all the panelists. Amazing discussions on downside protection and the growth of private equity and private credit market in India. My question is this: we have seen the growth of banking industry in last 20 years, and we have also seen the pitfalls during the cycles in last 10 years. Now, what I understand that we have a better quality of execution in terms of diligence and underwriting and all those things. I understand. What experience we can learn from the past NPA cycle which the bankers have faced, so that it's not repeated, apart from the evolution of the framework around IBC and other aspects. I can tell you that from a practicing perspective, it's very difficult for me to enforce any of my rights apart from enforcement of share pledge. So any insights from the panelist on the
Great question, actually. And this is an evolving, work in progress kind of thing. But I think the fundamental bedrock of private credit, as I think Sandeep mentioned, or someone else, I think Piyush, is to have rights enough to be a threat, and not put yourself in a position where you have to carry that threat through. I think that is the basis of underwriting private credit, in my opinion, because if you were to enter a transaction where there is a realistic chance of you having to enforce, right, probably that's not within the mandate of the fund. Let me put it that way. So accidents do happen, and you have to saber rattle a few times, but the bottom line, is that you have enough of a threat, and now with IBC, which is a real tool where you can take a company into receivership, I think the goal is to try and back situations and promoters and stages of companies that allow you to pass through the cap structure as efficiently as you can versus carrying the threat out. It's not a direct answer to your question because there is no silver bullet, suddenly that anybody can manufacture. But I think the goal is to be a smart, financier where you know your risks, you know your exit as you enter, but you write your documents in such a way that you have enough, or you present enough of a problem or a danger to the guy. And there are we run out of time, but there are nuances in terms of how you structure and upfront your returns and increase your DPI and make sure that you run more of a refinancing risk or rather recycling risk versus a credit risk. There's so many nuances into how you underwrite, but fundamentally it is, in my opinion, that you're enough of a threat, but you don't have to carry through the threat. I think that's the key. It's a philosophy. I don't know if anybody else has a view.
I think just to, in a very simple way, I think, there are just two principles of lending: intent and ability. I think this is now, both are now equally important. It's not just about, I think the past experiences, at least we've all been, and I've been a banker for a long time before moving into the fund, NBFC fund model. And I think the ability part of it is now becoming more and more important. So someone can have a great intent, but if he doesn't have the ability to repay you, then it can't happen. So I think the monitoring part of it, continuously being in touch with the, right from the promoter to the entire, this thing is, I feel, a very important part of doing. So it's about saying how well can you manage your asset on a continuous basis and not, and not just at the pre-disbursement stage.
And I think from a lawyer standpoint, I think I know that the delays still plague the enforcement, and you say that share pledge enforcement is, I think, one of the most real recourses that we have. There is definitely a quick recourse, but I think we are definitely not a rights light market anymore. IBC is a real threat, and while I see a lot of data which talks about how IBC has not led to the amount of recoveries that it should during resolution, but I think the real data lies behind that. That is the amount of settlement which has happened because of the threat, which has not even gone to court, or which has gone to court and has been withdrawn. So I think that way it has proved itself. I just wanted to add that.
A lighter vein, way back in the day when I used to run a distressed assets fund, I remember a particular situation where the promoter was very happy to let go of his shares, but not his bungalow in Aurangzeb Road. So I think he valued the Aurangzeb. Am I being cut off on?
No, sir, not at all.